All right, the market is a coiled spring, plain and simple. Here's the playbook for the next 1 to 2 weeks.
This quote really nails the current conflict. We've got this powerful bullish momentum on the surface, but underneath, there's some serious foundational risks that most people are just completely ignoring. All right, so let's get right into it. The market really is like a coiled spring right now. It's being pulled tight in two different directions by some really strong bullish tailwinds, and at the same time, some pretty significant bearish headwinds. And it's this tension that's setting us up for a really major move. So here's the battleground, laid out plain as day. In one corner, you've got the most powerful seasonal period of the year, a Fed that the market sees as supportive, and big institutions just snapping up every single dip. But in the other corner, you have a brewing credit crisis, geopolitical flare-ups, and signs of a weakening economy. It's a real tug of war.
Okay, let's start with the bull case. The argument here is pretty straightforward. A powerful, seasonality-driven rally right into the year-end. Now, the high conviction target from Evercore ISI is, well, it's a staggering 5,700 on the S&P 500. Let's be clear, from where we are now, that's a massive move for the market to price in over just the next couple of months.
This whole bullish thesis really stands on three main pillars. First up, you've got historical seasonality, which is a massive tailwind. Second, the market is pretty convinced the Fed has finished hiking, and that takes a major headwind off the table. And third, if you look at the fund flows, it's clear. Big money is treating any and all weakness as a buying opportunity.
So where are the bulls looking for leadership? It's right here. Semiconductors, think NVDA, are seen as the bedrock of this bull market. They're just consolidating before the next leg up. Then you have a high conviction setup in Oracle after that sharp pullback. And the real tell? A breakout in small caps. That would be the broad confirmation everyone's watching for.
Okay, now for the other side of the coin, the antithesis. The bear case basically argues that this whole rally is built on a really fragile foundation, and that traders are completely ignoring a major systemic risk that's brewing in the credit markets. And that risk? It centers on these things. Collateralized loan obligations, or CLOs. You can just think of them as big bundles of corporate loans. The problem, and it's a big one, is that right now they are being stuffed with more and more low-quality, high-risk, so-called covenant-light debt.
Look, we've seen this movie before, right? Back in 2007, it was all about repackaged mortgage debt. Today, it's repackaged corporate debt. The structure is eerily similar. In fact, some analysts are already flagging 2026 as the potential D-Day, the culmination point for this entire cycle.
The canary in the coal mine for all this systemic risk is the regional banking sector. We're talking about the ETF KRE. Why? Because they hold a ton of exposure to these risky CLOs. A break below the critical $57 support level in KRE, well, that would be a major red flag for the entire market. And this is all happening with geopolitical and trade risks simmering in the background.
All right, before we get into the playbook, let's be clear. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, so the battle lines are drawn. Bulls on one side, bears on the other. Now we need to figure out the specific catalysts that are going to decide who wins this fight over the next couple of weeks.
So the key question for us is, how do we position for this? How do you prepare for that spring to finally uncoil without just gambling on the direction?
While the options market is practically screaming where the short-term catalysts are, just look at earnings for Netflix and Tesla. The market has huge implied moves priced in. We're talking plus or minus 8 to 9%. These reports are going to be absolutely pivotal for tech sentiment.
You can forget all the other noise. These are the only two levels that matter right now. For the S&P 500, it's 5,300. That's the key gamma level, the point where dealer hedging can pour fuel on a fire and accelerate a sell-off. And for the bear thesis, $57 in KRE is the absolute line in the sand. A break there validates the whole systemic risk argument.
All right, let's get to the playbook. It's time to see how all this builds into some actionable scenarios and potential trade structures. Here are the triggers, plain and simple. The bull case gets the green light if the S&P breaks and holds 5450 and credit markets stay calm. The bear case is confirmed if KRE breaks $57, credit spreads blow out, and the S&P loses that critical 5300 gamma level. Remember, we don't predict, we react to these signals. Okay, setup number one, a pure volatility play on Tesla earnings. The market's pricing in a 9% move, but the direction, it's a coin flip. So a long straddle lets you position for that big move, no matter which way it goes. Now listen, this is a high-risk play because of the post-earnings IV crush. That's when the option's value just evaporates after the news hits. So sizing has to be a starter size only.
Next, setup number 2. If the bull case triggers, here's how you could play it with defined risk. A call debit spread on the semiconductor ETF, SMH. This lets you position for a breakout in what is the market's leading sector. The beauty here is your risk is capped, and you know you're wrong if the sector breaks its recent support. Clean invalidation.
And third, the bearish setup. If KRE cracks that critical $57 level, that's the signal the market is finally waking up and pricing in systemic risk. A put debit spread on KRE is a defined risk way to capitalize on that potential breakdown. This can work either as a portfolio hedge or as a straight-up speculative position if your conviction is high.
So, the big question is, how do you put all of these pieces together into a coherent plan? And this is really the most important takeaway. Stop trying to predict what's going to happen. Instead, identify the key levels and the key catalysts. Have a concrete plan ready for both the bull and the bear scenarios, and then execute that plan with discipline when one of those triggers is hit. That is how you navigate a market like this.
And remember, this is not trading advice. It's just a market update to keep you informed. Markets carry risk. Trade your plan, manage your downside, and always verify all data.